Hi, I'm Joe DeLisi, and this is the Joe DeLisi Financial Advisor Podcast. This is a special edition. Normally we come out every 2 weeks, but obviously we've had a little event happen. We had the 2024 presidential election, and I was a little surprised, not in the outcome per se, but in the fact that we knew the outcome the night of the election and it wasn't close. And generally that's good for markets. They want certainty. So, we're going to talk today about this election and maybe what to expect from markets moving forward with these results. And, I know that from what I've gathered, many of my listeners are clients and really advisors who know me pretty well, but we're getting a growing number of people who don't know me at all. And these are listeners that I don't know much about them either. So if you're tuning into this pod to get some juicy political take, you're not going to get it. I am a political animal. I've mentioned this before. If you know me, I watch politics, unfortunately, as closely as I watch hockey or the NFL or baseball. I mean, I'm a fan. I pay very close attention to politics. I went to college at the University of Maryland in the DC area, and so I enjoy it. I follow it and I enjoy it. But my job is not as a political analyst. And my job is to build balance sheets for people, for my clients. And generally, specifically what I'll say is it's really to help people as they build these balance sheets to turn cash flow from assets, right? So we're spending years building up assets that we will eventually turn into cash flow. And that's what I do. And I'm not a political guy in terms of how I'm going to help you, but I can look at politics and help use that as a direction as to where markets might go, where tax rates might go, et cetera. So it's in this context that I'm going to address the 2024 presidential election, really as a planner, as an investor, as a strategist for you and your money. Now, in building a balance sheet, there are several areas that have to be addressed. Because we're looking to optimize assets, we're looking to optimize cash flow. We have to look at things like I mentioned before, like taxes and where they may head in the future. We have to pay very close attention to your savings rate. Generally speaking, I want you to be saving about 20% or more of your gross income. We have to address, debt to asset ratio. We have to look at protection items, like disability insurance and property and casualty insurance and life insurance to put a moat around that castle, so to speak. And obviously, we're going to look and debate real estate holdings and debt instruments and things of that nature. But finally, we're going to analyze and build investment portfolios that adhere to very specific scientific and math principles and statistical analysis rather than using speculation or gambling. And it's really this last line item here that garners the most attention for many reasons. But perhaps the biggest reason it does is stock investing is just very emotional for people. Fear and greed often dictate directions a client might take rather than prudent, time-tested investor principles. So in an election year, specifically a presidential election year, midterms not as much, and also an emotionally charged, which have been, the last several election cycles, it's easy to allow outside influences to dictate directions a client might take as a result of an election. We are all emotional creatures. I get it. Now, the odds are high that you hold a very strong opinion of the outcome of the presidential election, and very high or very strong opinions of President-elect Trump's victory. You likely held a very strong opinion of him back in 2016, as well as President Biden's victory in 2020. It's just normal. So you're either very excited right now and maybe relieved that a President Donald Trump returning to the White House, or you're very disenchanted, you're worried, and maybe you're downright scared, that President-elect Trump is returning to the White House. In either case, I'm going to urge you not to allow any of those emotional responses you have, either positive or negative, to influence your investing decisions. So we're going to go back to just facts, okay? It's not to say that you shouldn't be emotional. Again, human nature, that's just what we're going to be. I'm emotional about it one way or the other. You are too. But there are just very solid fact patterns that will teach us where markets are likely to head after a presidential election year. So in virtually every election dating back to 1960, I'm going to look at some notes here, make sure I don't get these wrong. The S&P 500 has had a very solid increase. in the year post-election. Okay, so after the election has occurred, from that point forward, the next year, very solid increase, and that's just a fact. It's not a comment on who wins. The market, and this is funny to say, but it's also very true. The market does not care about your feelings. It doesn't. It doesn't care about how you feel about President-elect Trump. It does not care about how you feel about the sitting president, President Biden. It does not care about how you might view candidate Harris. It doesn't care. The market doesn't have feelings. It doesn't care about red or blue politics. It's just math. So here's a look at stock market performance in the year following each U.S. presidential election. I'm going to go back to 1980 just to keep it recent. The data I saw actually went back to 1960, and it all pretty much held the same pattern. But I like to go back to 1980, honestly, because that's when I remember things. I was born in 74, so growing up as a child of the 80s, I remember the way life was. I remember feelings around it too. So for brevity's sake, we're going to use 40 years, okay, or roughly 40 years. So 1980, here's what we got. Ronald Reagan, after Reagan's victory, the S&P rose about 7%. Now, his economic policies that we would later refer to as Reaganomics, they all began to kind of take shape. 7% was actually a fairly low number compared to 1984. In 1984, this was Reagan's re-election. The S&P 500 had very strong growth. So 7% after his first year after the election, 26% increasing following his 1984 re-election. Really, that's just a boost of the ongoing economic expansion, and then also tax cuts. We had significant tax cuts in the 80s under Reagan. 1998, I call him Daddy Bush, George H.W. Bush. Market increased by about 27% in the year following Bush's election. And this was somewhat, if you just look at the history of it, this might be a little surprising, actually, because he was a one-term president, H.W. Bush. And I mean, a lot of times this is just viewed as Reagan's third term, so to speak. But really, 26% growth was better. 27% growth was better than Reagan's 26 and better than Reagan's 7 in 1980. It really just reflected a boost in economic expansion. The tax cuts were still working through, and we were getting the benefit of that. And then 1992, we had Bill Clinton. Kind of a surprise candidate, right? I mean, if you go back and look at this, it was just an assumption that HW was going to win re-election. It did not work out for him. He made some strategic errors. He did not win re-election. He lost to a relatively unknown at the time Arkansas governor, Bill Clinton. And, people were worried about that. Look, the right was very worried about that, the inexperience of a Bill Clinton presidency. Well, the market didn't care because his win was followed by an 8% gain as the economic recovery from the early 90s, a recession, basically continued. Now we've got 2000. Okay, so actually I missed Mr. Clinton's re-election. We'll have to go back and look at that. But in 2000, we had George W. Bush. So the 2000 election was an outlier here. It was followed by a 12% decline in the S&P 500. And look, this is largely influenced by the burst of the dot-com bubble. I want to point this out and I want to take a second to talk about this because in 2000, going into 2000, I got in the business in 1998. Clients were very, very, very heavily weighted in the S&P 500 and significantly weighted towards the NASDAQ or tech stocks. And what we now know is we had a 75% decline in the NASDAQ. From 2000 to 2002, the end of 2002, took 15 years for the NASDAQ to recover. Guess what? Again, I've mentioned this in podcasts before. That's where several of you are heavily weighted right now. Very overly tilted towards the S&P, all very tech-centric. Back in 2000 and leading up to it, it was the internet revolution, and now it's AI. Okay, so I don't know where we're heading, in the next 3 years, but history a lot of times rhymes with its, with what's happened before. So that was 2000. Let's go to 2008. So this is the election of Barack Obama. Very emotionally charged year too. This was Obama and McCain. Now I don't think this took anyone by surprise that Obama won election that year. McCain, wasn't an overly strong candidate, but again, you had this: does he have enough experience? Background. And people were worried. Well, in the year following Obama's first election in 2008, the market rose 26% after the financial crisis. Again, a lot of recovery measures, a lot of bailouts. You can feel one way or the other about that. But the fact is the S&P was up 26%. 2016, Donald Trump. Now, 2016, nobody expected this, or at least most people didn't expect this. I find all kind of people saying they knew he was going to win. Well, I didn't. I remember watching that election on my couch in Tennessee, where we were living at the time. I remember watching it all night long. And people were very, very worried about a Trump presidency. We had people out there like Mark Cuban saying that he had 100% hedge on in case Trump won because everything was going to crash. Well, the market didn't agree. The market doesn't care, right? It doesn't care about Trump's personality. It doesn't care about Obama's personality. It doesn't care about Harris's personality or Biden's personality. It doesn't care. The market, following a Trump election in 2016, rose 20%. And I think this was primarily, if we look back, it was due to expectations of things like corporate tax cuts and deregulation, which did occur. Then we had 2020. 2020, we had the pandemic. We had a very contentious election. We had the nation heavily divided, right, along policy or partisan lines. And I can just tell you that a lot of my clients and my advisory friends who tend to be on the right of the aisle, they expected the market to absolutely crash. It didn't quite crash. Following Biden's election, the market was up 30%, actually the highest number of any of the data points that I've got in here. And this was, again, vaccine rollouts, fiscal stimulus. At the time, we thought it was a post-COVID-19 kind of euphoria. We thought that COVID 2019 was behind us. Markets took off. So again, generally, the stock market has rebounded in the year following an election, mostly over economic principles and things that are going on, not feelings, not what one side says about the other. Not how you feel about it, right? Not things that you've seen on Twitter or TikTok. It's got nothing to do with that. It's got everything to do with economics. So there are some exceptions like 2000, which were tied to specific economic events rather than the presidential transition itself. So look, you're either looking forward to the next 4 years with optimism or skepticism. The only thing that I would have for you is as your advisor, again, the market's not emotional. It just continues on and on. It's going to continue to do so with Donald Trump in office. It will continue to do so after the midterms and after the 2028 election and so on. Okay, it's how this is going to work. Short-term fluctuations are going to occur. All right, we don't know where the next 20% is going to be. Is it up or down? We don't know. The next 100% movement is never down. You never lose 100% in the market, but we have doubled several times. So the free market economy can very well continue, and it can provide the risk premiums or the returns, for the risk you're willing to take, should you choose to be a long-term participant. My job is to keep you in it. Now, it's not enough for me just to say, stay in it, be a long-term investor. I have to give you reasons, right? Like the data we just went through. If there's no palpable and tangible reasons for you to be a long-term investor, well, then why would you stay? Right? Why would you take all of this emotional turmoil and turbulence like we talked about in the last podcast? So we have to provide you with that data, and we're here to do so. So that's my message. Thankfully, we can put the 2024 election behind us. I'm sure people are already talking about 2028, and we'll deal with that as it comes. Before that, we've got we've got cabinet appointments. We've got 2020 midterms. 2026 midterms. We got a lot going on. We'll be here to follow all of it and to kind of give you some context for all of that. For compliance, registered representative, financial advisor, Park Avenue Securities, LLC, Pass OSJ, 5280 Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-684-6400. Securities products and advisory services offered through Pass. Member FINRA, SIPC, financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California Insurance License Number OD34103. This podcast is for informational purposes only. It is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Pass, Guardian, or Westpac Wealth, and opinions stated are their own. Guardian and subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protection against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual situation or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index. 7285489.1 expires 11/20/26.